Today, we are going to talk about limited companies. What is limited company? Limited company is a type of business structure where the company's finances are separate from its owner's personal finances. There are two types of limited companies: public limited company, PLC, and private limited company, LTD. PLC is a company that is authorized to issue shares to the public, while LTD is a company that is not authorized to issue shares to the public. What are the advantages and disadvantages of limited companies? Well, for advantages, 1. Limited liability. Shareholders' personal assets are protected. They are only liable for the amount they invest. 2. Separate legal entity. The company exists independently from its owners, meaning it can enter contracts, own property, and sue or be sued. 3. Easier to raise capital. Can issue shares, especially PLCs, to raise funds, making expansion easier. 4. Tax benefits. Corporation tax is often lower than personal income tax, and there are allowable business expenses. 5. Credibility and professionalism. Having LTD or PLC in the name can boost trust with clients, suppliers, and investors. 6. Continuity. The company continues to exist even if ownership changes due to the death or exit of shareholders. While disadvantages of a limited company are complexity and costs, registration, annual filings, and compliance with regulations, e.g., financial statements and audits, can be costly and time-consuming. 2. Public disclosure. Some financial information must be shared publicly, especially for PLCs. 3. Taxation issues. Although corporation tax can be lower, directors may still face personal taxes on salaries and dividends. 4. Less control for owners. In large companies, original owners may lose control if they sell too many shares. 5. Regulatory compliance. Strict legal requirements, including filing annual returns, maintaining statutory records, and following corporate governance rules. 6. Profit distribution restrictions. Profits belong to the company, and shareholders can only receive dividends if the company has sufficient reserves. In this topic, you will be prepared the statement of profit or loss, statement of changes in equity, and statement of financial position for a limited company. Statement of profit or loss. There is no difference from the usual format for statement of profit or loss, but there is some additional information such as distribution costs, profit or loss from operations, finance costs, profit or loss before tax, and tax. Next, statement of changes in equity. But before that, let us go through the terms commonly used in limited companies questions. First, what is a dividend in accounting? A dividend is a portion of a company's profits that is distributed to its shareholders as reward for their investment. As what we have learned before, there are two types of dividends, which are 1. Interim dividend, which is paid before the end of the financial year based on estimated profits. 2. Final dividend, which is declared at the end of the financial year after finalizing accounts and approved by shareholders. Let us do an example regarding dividends for further understanding. In a scenario where a company declares a final dividend of 50 cents per share on 20,000 ordinary shares, we must know what is the journal entry and then calculate the amount the declaring dividend, which creates a liability. In this case, we will debit the retained earnings, 20,000 times 50 cents equals $10,000, and then credit the dividend payable by $10,000. Then, credit the bank by the same amount. Key points to remember are: 1. Dividends reduce retained earnings but do not affect profits. 2. Shareholders do not have a legal right to dividends unless declared by the company. 3. Companies may choose not to pay dividends and reinvest profits into the business, retained earnings. Right issue. What is a right issue? A right issue is when a company offers new shares to existing shareholders at a discounted price before offering them to the public. This helps the company raise additional capital while allowing shareholders to maintain their ownership percentage. Key features of a right issue are: 1. Shares are offered at a lower price than the market value. 2. Only existing shareholders can buy the shares in proportion to their holdings. 3. Shareholders can accept, sell, or ignore the offer. 4. It raises capital for the company but does not affect reserves like a bonus issue. An example regarding right issue is a company has 500,000 shares of $1 each, and it announces a 1:5 rights issue at $1.20 per share. Before we proceed to the calculation, we must know 1:5 right issue stands for. The number 1 represents the number of new shares offered, while number 5 represents the number of existing shares required eligible for 1 new shares. which means if a shareholder owns 5 shares, they will be eligible to buy 1 extra share. After we already understand it, let us do the calculation of the new shares available. That is 500,000 divided by 5 equals to 100,000 shares. The total funds raised is 100,000 times $1.20 equals to $120,000. Then, the nominal value is 100,000 times $1 equals to $100,000. Lastly, the share premium will calculate $1.20 minus $1 and times $100,000 equals to $20,000. Next, the journal entries are debit bank by $120,000. Then, credit the ordinary share capital by $100,000 and finally credit the share premium account by $20,000. Bonus issue. A bonus issue is when a company issues free shares to its existing shareholders instead of paying cash dividends. Let's do an example regarding bonus issue. A company has 1 million shares of $1 each and decides to issue a 2:10 bonus issue funded from the share premium account. Let us do the calculations first, where the new shares issued is 1 million times 2/10 equals to 200,000. So, the amount transferred from share premium is $200,000. The journal entry for this are debit the share premium by $200,000 and then credit the ordinary share capital by $200,000. Key points to remember for a bonus issue are: 1. There is no cash received. Only reserves are converted to share capital. 2. Increases the number of shares, reducing the market price per share. 3. Retained earnings or share premium is used, not revaluation reserve. 4. Shareholders benefit by receiving more shares without shares paying extra. Share premium. Share premium is the extra amount received by a company when it issues shares above their nominal, par, value. The difference between the issue price and nominal value is recorded in the share premium account, which is a capital reserve and cannot be used for dividends. Let's do a scenario where ABC Ltd issues 10,000 ordinary shares of $1 nominal value at $1.50 per share. So, the calculation will be for the nominal value is 10,000 times $1 equals to $10,000. The share premium will be 10,000 times by 50 cents, $1.50 to $1, equals to $5,000, and so the total cash received will be 10,000 times by $1.50 equals to $15,000. The journal entries will be debit the bank by $15,000. Credit the ordinary share capital by $10,000 and share premium account by $5,000. So, the key takeaways to remember about share premium are: 1. Share premium arises when shares are issued above nominal value. 2. It is recorded in a separate share premium account. 3. It cannot be distributed as dividends but can be used for bonus issues. Debentures. What is a debenture? A debenture is a type of long-term loan or bond issued by a company to raise capital. It is a form of debt financing where the company borrows money from investors and agrees to pay interest at a fixed rate. An example to this is XYZ Ltd issues $100,000 of 8% debentures at par value, i.e. $100 per debenture, to raise money. So the journal entries for this are debit bank by $100,000 and credit debentures with $100,000. The company must now pay 8% annual interest on this amount, which will the interest per year will be $100,000 times by 8% equals to $8,000. So, the next journal entries will be debit the interest expense by $8,000 and bank by $8,000. The key takeaways to remember about debentures are: 1. Debentures are loans taken by companies, not shares. 2. Fixed interest is paid to debentures holders. 3. Issued at par, premium, or discount depending on demand. 4. Can be secured or unsecured, redeemable or irredeemable. Let's try doing some past year paper. The question instructed us to prepare the income statement or statement of profit or loss. Always remember the format for statement of profit or loss. Firstly, record the amount of sales or revenue that is already given in the question, which is $984,000. After that, we have to find the cost of goods sold, which is opening inventory amounted $98,000 plus credit purchases amounted $480,000 and minus the closing inventory amounted $105,000 equals to $473,000. Then, $984,000 subtract with the cost of goods sold, $473,000 equals $511,000. This figure is the gross profit. Next, we have to record the administrative expenses. However, we need to make adjustments, according to the information given, All annual depreciation is to be charged to administrative expenses. So, we need to calculate the depreciation for buildings and plant and machinery, and also the provision for doubtful debts of trade receivable. Let's start calculate the depreciation of plant and machinery, which is 204,000 minus 94,000 times 10% equals 11,000. Next, depreciation of buildings, which is 50,000 times 2% equals 1,000. Then, calculate the provision of trade receivable, which is 109,000 minus 9,000 times 3% equals 3,000. Also, don't forget to include the 9,000, which is the written-off trade receivable. Then plus all together, you will get 229,000, which is 205,000 plus 11,000 plus 1,000 plus 3,000 plus 9,000 for the administrative expenses. Thirdly, record the distribution cost amounted 197,000. Then plus amount administrative expenses and distribution cost equals to 426,000. After that, 511,000 minus 426,000 equals to 85,000 and label it as profit from operations. Then, minus it with finance cost amounted 14,000, which is interest paid of 13,000 plus 1,000 from debenture. Lastly, 85,000 minus 14,000 is equal to 71,000, which is the profit for the year. Question B. Prepare the statement of changes in equity for Baylis Limited. This statement summarizes the changes in share capital, share premium, revaluation reserve, general reserve, and retained earnings for the year ended December 31st, 2015. Let's break it down step by step. 1. Beginning balances, January 1st, 2015. Share capital, $140,000. Share premium, $3,000. Revaluation reserve, $0. General reserve, $21,000. Retained earnings, $61,000. Total, $225,000. These values come from the trial balance provided in the question. 2. Dividend paid of $10,000. The trial balance shows dividends paid of $10,000. This reduces retained earnings. 3. Bonus issue of shares. A 1 is for 20 bonus issue means for every 20 shares held, 1 new share is issued. Given that share capital initially was $140,000 with shares of 50 cents each, the number of shares was 140,000 divided by 0.50 is equal to 280,000 shares. Then, 280,000 divided by 20 is equal to 14,000 new shares, and 14,000 times 0.50 is equal to 7,000. 4. Revaluation of land of $15,000. Land was initially recorded at $135,000, but was revalued to $150,000. The increase of $15,000 is credited to the revaluation reserve. 5. Profit for the year $71,000. This value is obtained after adjusting for depreciation, bad debts, and other expenses. It is added to retained earnings. 6. Ending balances for December 31st, 2015. Share capital increased by $7,000 due to the bonus issue, which equals to $147,000. Share premium reduced to $0 after the bonus issue. Revaluation reserve increased by $15,000 due to land revaluation. General reserve reduced by $4,000 due to the bonus issue, which is $17,000. Retained earnings adjusted for dividend and profit of $122,000. Total equity $301,000. For the statement of financial position, it is just like any other financial position, however, there is a new header under equity, which will be explained in a bit. So firstly, we will have to record down the non-current assets, which consists of land and building and plant and machinery. For land and building, the cost is $200,000. This is because it was mentioned in additional information number 2 that land is included in the trial balance at a value of $135,000. It is to be revalued to $150,000 at December 31st, 2015. With that information, land will have the value of $150,000 and not $135,000. Then to get building, take the value of the original costs of land and buildings, $185,000, and minus the original value of land, $135,000, which will equal to $50,000. Land equals $150,000. Buildings equals $50,000. Total equals $200,000. To calculate depreciation, Building depreciation is using straight line method, so $50,000 x 2% equals $1,000. For land, the depreciation is $23,000. Total depreciation equals $24,000. Book value equals $176,000. For plant and machinery, the cost is $204,000 and is depreciated using reducing balance method. So take $204,000 minus the provision for depreciation of $94,000. $204,000 to $94,000, x 10% as stated in the additional information. Next is current assets. Trade receivables $109,000. The additional information states that there is $9,000 irrecoverable debts to be written off and a provision of doubtful debts of 3% of trade receivables. So take $109,000 to $9,000, x 3% equals $3,000. Irrecoverable debts, $9,000 plus $3,000 equals $12,000. The trade receivables of $109,000 minus $12,000 equals $97,000. Closing inventory $105,000. Other receivables $3,000. Total current assets will be $205,000, and then total all the assets is $480,000. Next is equity. You will have to transfer all the totals from the statement of equity. Share capital $147,000. Revaluation reserve $15,000. General reserve $17,000. Retained earnings $122,000. Then total it all up and you should get $301,000. Under non-current liabilities there is debentures $80,000. And current liabilities there is trade payables $59,000. Cash and cash equivalents $32,000. Other payables $7,000. And lastly, debenture interest. $80,000 x 5% equals $4,000 divided by 12 months, and then x3 as the debenture interest has only been paid until September 30th equals $1,000. The total of current liabilities should be $99,000. Then you will be able to get the total liability and equity of $480,000. That's it from us. Thank you for staying until the end.